Just a very local Northern Ireland question. We have an election going on now, and all the parties seem to be agreed that the key to recovery here is to reduce corporation tax to 10% as a republic. They've identified this as a reason in the republic, and to cut elsewhere to cover that, because it would have to be met out of the local budget. Is that a silver bullet for us?
It's obviously not enough. I mean, but if small states have to encourage FDI, and you've got to encourage people to stay, and it's one necessary but completely insufficient condition to do the work that I was talking about, and actually Michael was talking about. I mean, I think if you're going to, it really isn't big enough in a Northern Irish context to address the scale of the problem, in my view. But it's as a standalone proposition, a good idea.
Okay, but tinkering around the edges to a certain extent.
Nigel Smith, CBI. Question for Will again. Your slides were quite frightening on your debt figures, but do you not need to look at those more in the context of assets and liquidity and various things? And you painted a very depressing picture, and I think we all agree it's challenging. How would you comment?
Yes, I mean there's a number of points to make about that. I mean, the first point to make is that the issue is not capital ratios, it's not liquidity by themselves. I mean, you have to think about how a bank operates in totality. Can the management team manage the span of operations? I mean, some of these large, complex financial institutions, RBS, for example, has had 7,000 special purpose vehicles. And can you understand, as a management team, actually understand the risk that is on your balance sheet? And the growing view is that the optimal size of a bank is somewhere around $100 to $150 billion in assets. And once you get beyond that, the capacity to understand the risk that you're running gets poorer and poorer. Then you have the business model, which is about the recategorization of tail risk to normal risk through securitization, and trying to lay off the risk through credit default swaps. That business model is bust, and the risk management techniques associated with it are bust. So what you've got in Ireland is you've got 3 banks with assets that at the peak were in excess of 5 times GDP, that have own lending to support them. I don't think the management teams of those 3 banks understood and understand the risk they were undertaking. They've actually had to turn to the Irish state to support it. And it seems to me that, obviously, you don't throw the baby out with the bathwater, but actually the job that Ireland faces is very analogous to the job that Britain faces. And one of the interesting, that you're going to have to break up your banks. Break them up, sell them off, and have them, and have both a smaller banking system and, I think, more small banks. And by the way, that would be very good to populate your innovation ecosystem. That's exactly the proposition in Britain. Now, there's an election in Britain, and I think that there is, the most likely outcome is a minority Conservative government supported informally by the Liberal Democrats. If that's the case, the Liberal Democrats will push for bank breakup as part of the agenda of government. The next most likely option, and we'll see on Thursday who wins the debate. If Nick Clegg does well or wins the debate on Thursday, and you get a fresh surge of Liberal Democrat support, so the Lib Dems were to come first in the popular vote in Britain, I think it not unlikely that you could have a Clegg-led Labour-Lib Dem coalition, with Gordon Brown resigning within 24 hours of losing the election, because the way the hung parliament works in Britain is actually, although the Lib Dems will get a majority of the popular vote, and they only get 120 seats or something, and the Labour coming in last would have 230 or 240 seats. That commands a useful working majority in the House of Commons. In those circumstances, a Clegg-led government with Vince Cable as Chancellor would without doubt break up RBS and Lloyds and would split Barcap from Barclays. So, this agenda of bank breakup is going to be very much on the table in the next 12 or 18 months. It's what the Bank of England want. And if the Tories actually get the FSA to be run by the Bank of England, then the people who run the bank will recommend to the government that Britain's big banks get broken up. If that's the agenda in London, there should be a parallel agenda in Dublin.
Could we open that up to the wider panel here? Linda, would you like to add to this?
Let me just add a few things to what Will has said about where the general global consensus is moving on the issue. The IMF at the G20 finance ministers meeting just this weekend has proposed something much less drastic than a breakup of the banks. What they're suggesting is a global flat levy on bank profits. So banks create a self-insurance fund, and they're also recommending a resolution scheme, so a living will for banks, so that should they get into trouble, they could just dissolve without causing widespread financial chaos. And also a tax on bankers' pay and profit. So in other words, trying to tax away the problem of too big to fail. Now, of course, this mild version hasn't actually gained global consensus. Canada is very much against it. Australia is against it. Japan's against it. So what this means is that there's also other proposals floating out there. The US is going to try and push for something called the Volcker Rule, which would ban banks from proprietary trading, kind of going back to Glass-Steagall. The Financial Stability Board have global counter-cyclical capital liquidity requirements. You can kind of see where I'm going on this, is that no one country can do this on their own, and yet it's such an important issue. There's just no fundamental agreement on what this means. And I think this kind of policy uncertainty is going to plague all countries trying to deal with the aftermath of the banking crisis. How do you know what to do with bank assets if you're not really sure what the future global regulatory regime might look like? And yet dealing with it, by the way, is absolutely fundamental to the public deficit issue. If you look at Great Britain, the bailout of the banks is why the British national debt is not 53% of GDP, but is instead 63% of GDP. That's how much the banking bailouts have cost the taxpayer. So resolving it would help bring down the deficit a great deal.
Just moving on to talk about what may be the implications for this island in the wake particularly of the Greek story this week. What's your view on the panel with regard to whether or not we're going to see a two-speed Europe, and is Ireland going to be part of that? Michael, would you like to touch on that one?
Taking the issue of two-speed Europe, first of all, I think on balance, if you look through some of the gathering wreckage in bond markets, I think it's a more and more likely option. It would make the euro a lot stronger if you sort of chucked out Greece and Portugal, but the euro as a construct is political as well as economic.
Well, they chuck out
and
Ireland, Michael.
Well, I think also if a country was chucked out, to put it bluntly, they would never, or they should never be allowed back in. I think some of the potential entrants to the Eurozone, Estonia, for example, are in a curious situation now, in that arguably some of the regulations, guidelines could be made more stringent. I think if there was a two-speed Europe, I think Ireland should be in it. I think it is critical, again, to make this point, that if we are part of a financial or economic arrangement involving other countries where things like interest rates are set somewhere else, then we have to set up counterbalancing measures. And that, for me, is this, as well as poor regulation and policy making, is the source of our bubble. Interest rates were far too low for too long in Ireland, which is classically the ingredients of an asset price bubble. So there should be a mechanism, for example, that if interest rates in Europe are lower than is appropriate for us, then we should have a tighter fiscal situation. So I think it's an increasing possibility. It's not, but the actual probability yet is low. And if it happened, I think Ireland should be part of it. Yeah.
Barry, what do you think of the odds?
So the last, I don't know if the wireless works. It does. The last couple of years have reminded us that many things we thought would never happen can happen, but I remain of the belief that the possibility of a country leaving the Eurozone, the most likely candidate, of course, being Germany, that the probability of this happening is vanishingly small, and that we'll be here next year, or 5 years, or 10 years from now, being amused by how seriously people temporarily took the possibility in April of 2010 that a country might leave the Eurozone. It's politically extremely difficult. It's technically almost impossible. It would have to be debated in the Greek parliament. That debate alone would cause the mother of all financial crises. There are some clever ways to get around that problem that are equally infeasible in my view. So I don't think this is going to happen. One more word on the bank breakup view, so I can debate Will now that he's vacated his chair. We have very much the same debate in the United States, and I would really distinguish between what many people would like and what is feasible. So I think many people would like to break up banks that are too big and too politically influential and too connected. But there are realities that these banks exist, and breaking them up before without nationalizing them and taking them over is, again, very, very difficult. Almost as difficult as breaking up an existing monetary union. So I think, except under very extreme circumstances, we're going to have to get serious about the measures that Linda was describing and think how to impose progressive capital requirements on banks that rise with bank size, that rise with the threat they pose to systemic stability, to make big banks less dangerous rather than to imagine we can make them disappear.
Can I just add a word on the euro, and then we'll just to say that I think the stability of the euro at the moment actually depends on having a new mechanism, which has been proposed to create something like a European Monetary Fund, some type of liquidity backstops, because all countries can't get into liquidity problems, and if they do, there has to be a timely solution in order to resolve it. Part of the Greek crisis, why it's really cast out over the euro, is the length of time it's actually taken to come up with some way of providing liquidity needs to Greece. And I think coupled with that is there is now a disbelief in the Maastricht Treaty and the ability of countries to impose fiscal discipline. And I think the Greek situation is atrocious, of course, in many ways, because the statistics were unbelievable. But it does point to, again, a fundamental issue, which is how do you impose fiscal discipline, and what kind of orderly mechanism can be there to help countries who might get into trouble from time to time, not systematically, but from time to time, that can reassure markets that the euro will be stable and won't be dragged down by very, very actually small countries like Greece. So I think there's a lot of ideas that yet have to be aired there, and it's not just a question of coming up with 45 billion euros for Greece this year. There are deeper structural issues that have to be contemplated.
Okay, we're going to have to do things the harder way.
I have a question on corporate governance, and Michael, you mentioned the very good report out from the financial regulator down in Dublin yesterday. But really, is the system not so rotten that we've got to reform the whole idea and challenge, well, I challenge the system of shareholder value. The fact that most Irish companies and British companies are run by males over 55, accountants in the main, educated in private schools, who are all, you know, scratch each other's backs. We saw how rotten it was. Anglo-Irish Bank is just the epitome. But is it not going to happen again, even with if we legislate from the combined code, from self-regulation? And I'd like to hear the others' views on that.
Yeah, say a few things. I mean, we part of the fascination of these bubbles is that countries and economies seem never to learn from each other. So 7 years ago, we had a proper corporate governance crisis in terms of you know, some of the Enron, etc., and some of the indebtedness of the technology sector, etc., etc. And quite stringent measures were, in terms of the Sarbanes-Oxley Act in the States, were put in place to try and deal with that. But if you like, the risk-seeking, the leverage has gone to other sectors, i.e. in finance. So in some respects, it's more of a human than a sort of a model or structural model problem. In other economies like France, this is why I brought up the issue of the big evil market, because France is a very old economy. It's experienced lots of these crises, and as a result of that, you have a whole layers of mechanisms that are built into the French economy to stop things like speculation. And in good times, those measures are criticised for slowing growth and making the economy maybe less dynamic. So I think we have to be very, very careful as to what exactly we are tackling. I think in Ireland, my own personal view is that there's a whole range of Irish institutions have failed, not just in terms of regulation, and potentially like some institutions in the UK as well. These institutions were founded and were set up in a completely different era, and for economic conditions and maybe political and social conditions that we're just not thought of, and that's why I think they need to be rethought now on an aggressive basis.
Barry?
What ultimately caused the financial crisis? We all have our favorite answer to that, and we can point to different villains. In the United States, I would point to boards of directors who ultimately bore the responsibility for ensuring in the financial sector that compensation schemes gave actors within those financial institutions appropriate incentives. The answer should have been corporate boards of directors, and they clearly demonstrated their inability to do the job. Having sat on the board of a nonprofit, I can understand their problem when they meet quarterly and they're overwhelmed by information that only the insiders can really understand. But the lesson of this comes back, I think, to that markets can't self-regulate, and that where corporate boards fall down on the job, the solution is not only to change how they're constituted and populated, but embed them in a regulatory framework. And we've had an expensive reminder of the importance of doing that.
Linda, what does Asia teach us on this?
Well, I was about to say, yeah, I can touch on that as well. I was about to say I used to be a corporate lawyer, and for every regulation, there's a team of lawyers ready to try and get around it. But I'll just say a brief word and then touch on what Asia has done. I mean, I think what's essentially happened is that laissez-faire became light touch, which became self-regulation. It's actually quite a mistaken view of the evolution of markets and regulation. Markets always innovate. Regulators are almost by definition always behind. But the whole idea of having a regulator, rather than just having a set of written regulations, is that the regulator should actively monitor the goings-on of banks and of corporations, because laws are always too late. They never can keep up with CDOs or whatever, whatever is going on. So I think the problem in that sense, the financial deregulation of the 1980s, in Britain this was the Big Bang of 1986, is that somehow this lagging behind became no regulation. And I think in many ways Britain enshrined self-regulation. It's called enlightened self-regulation, but that was never really the point of laissez-faire markets. No market ever operates without rules and institutions, and it's just a question of making sure the regulators can actively monitor what's going on. We should never have believed that markets can govern themselves. The invisible hand doesn't give you rules. The invisible hand just gives you trades. So I think that's always been a fundamental gap between what lawyers actually do and what economists view markets has. In terms of Asia, they didn't really suffer that much from this crisis, not because they have great corporate governance, but actually it's because they have underdeveloped financial systems. So most Asian banks, after the Asian financial crisis, tightened on their regulatory systems anyways, which is also why Canada didn't suffer a really big crisis. But at the same time, they never had the depth in financial markets to do the kind of CDS and kinds of complicated securitized trades that have made this crisis such a severe one. So, for instance, in places like China, they don't really do derivative trading. Very, very little of it is actually done. And so, therefore, the problem with this crisis is that nobody knew what was going on in terms of the complexities of the toxic assets. And that just wasn't really there in Asia. It's actually what's called the advantage of backwardness. But then in the good times, it felt as if Asians weren't able to benefit from this strong growth in profits and what have you. And of course, in the good times it doesn't look so good, and I suppose in the bad times, they look pretty good. And now the Asian banks are the biggest in the world. Chinese banks are the biggest in the world. The Asian stock markets are the biggest in the world. So, I guess it is good to be backward sometimes.
I noticed accountants and the business owners in the room were raised. So have we a question from a business owner and accountant? Chairman.
Yes, can I ask a question on currency? It's a big issue for us here, and the rapid decline in the value of sterling has perhaps distorted trade on the island and has caused issues for the south of Ireland on competitiveness. Linda, in your presentation, you opened the box on perhaps whether the yuan or renminbi is going to become a reserve currency going forward. I know, Michael, you gave your book a plug, and last night, Barry, you gave your recent book on the dollar a plug. What's the future of the dollar as a reserve currency? How does the panel see currency volatility and movements going forward? Will the euro strengthen? Will the Greek crisis weaken it? Is sterling going to make a comeback? What's currency for the next 6 months? And is the dollar going to lose its standing in the globe in terms of the reserve currency of choice?
Big one.
Well, I cannot resist giving my book a plug. Thank you very much. It's called Exorbitant Privilege, The Decline of the Dollar and the Future of the International Monetary System. I should preface it by saying economists' models for predicting currency values over a period like the next 6 months are totally worthless. So don't believe anything that we're about to say. We don't know any better than you do what's going to happen to currency values over a period like 3 or 4 or 6 months. But our models are pretty good for predicting what will happen over 3 years or 5 years or longer. I think the U.S. still has a twin deficits problem that will require us to save and export more. Mr. Obama has a plan or a goal of doubling U.S. exports in 5 years. So we can double U.S. exports in 5 years in 2 ways. The miraculous way by assuming that we will be able to raise our productivity growth, and the realistic way, which is a somewhat weaker dollar. So I still feel confident over that longer horizon that the dollar will weaken against some other currency. In terms of the structure of the international monetary system, Linda and others reminded us we're moving toward a more multipolar global economy. I think we'll move toward a more multipolar global monetary and financial system. So the dollar will be the main international currency used by countries that trade with the United States. The euro will be popular for countries in Europe's neighborhood, however you wish to define that. And the renminbi will be used as an invoicing and settlement currency, and eventually as a currency for financial transactions in Asia, which will be China's neighborhood. And so my view is that 10 years from now, the dollar will be first among equals. The euro will be second, and the renminbi will be third. And the one thing I would add to that is a little bit of history, that in 1914, the dollar accounted for 0.0% of central bank's foreign exchange reserves. The dollar was used to finance 0.0% of international trade. The dollar was used to finance 0.0% of US foreign trade. The US relied on London for trade credit and other international finance. It took us exactly 10 years to become the leading international currency. The dollar accounted for the majority of foreign exchange reserves in 1924. More international trade was financed and invoiced in dollars in 1924 than in sterling. So my point is it can be done in 10 years from a standing start, and China is already moving. There were some rather extraordinary changes in those 10 years, like World War I and the creation of the Fed, but it's history worth remembering.
That leads very seamlessly to you, Linda.
The dollar can weaken if it was allowed to weaken against the renminbi, if the yuan wasn't actually pegged to the dollar. I mean, I completely agree with Barry that most economic models can't do short-term valuations of currencies. We can only tell you what happens when PPP, purchasing power parity, deviates. So inflation differences, deficit spending, purchasing power changes over the longer term. And I suppose whenever I think about currency swaps, currency trades, you know, I'm always told it's always a bilateral. It's always euro dollar, dollar yen, euro renminbi. It's always against something. So I think in the short term, my view talking to currency traders is always, oh, how's the dollar looking to you? Oh, it looks weak. The US wants it to be weak, all that deficit. And then I'll say, well, then what about the euro? Oh, the euro. Look at Greece, look at Portugal. Oh, they don't have no political backing behind the euro. That's going to look weak. What about the yen? Oh, have you seen Japan's national debt is 200% of GDP, and Japan is recovering by exports to China. So the yen's going to be weak. So by the end of this, I'm thinking dollars are weak, euros weak, and yen is weak. It's a question of relative weakness. But one currency that should be strong is actually the renminbi. Based on savings, trade surplus, purchasing power growth, real growth. There's a lot of reasons why the renminbi should actually be stronger. And I think that is probably the trend of the future, which is the renminbi at the moment is not convertible, but it's already increasingly being used in regional currency swap agreements within Asia, and also with commodity exporters to China, Russia, Brazil, Venezuela. Who knew Venezuelan oil could be refined by the Chinese? For a long time, they could only be sold to the Americans, regardless of what Chavez says. So this means the renminbi is already being used, and I think it will be the case that the renminbi will become increasingly an internationally transactable currency. And when I describe China's capital account liberalization, that's clearly part of it. You cannot liberalize your capital account without increasing the flexibility of your currency. So I think this is very much in the cards. How quickly it gets there, I think, you know, the 10-year time horizon Barry mentioned sounds very plausible to me as well. Because if you recall 1999, when the euro was created, it was very much like the Deutschmark. But remember, the Deutschmark was never used as a reserve currency to the same extent. And within 10 years, the euro now accounts for a fifth of global reserve holdings. And so it's a pretty fast expansion based on the fact that it's a big single market, and there was confidence in the stability of the euro. And I can very much see the Chinese currency going the same way.
Over dinner last night, Michael made a very provocative suggestion in regard to the two-speed Europe issue, and if Ireland got, you know, utterly on the wrong side of that argument, that we might adopt the dollar. Michael, would you like to come in on this one?
Yeah, well, I mean, the dollar is still the only currency zone, if you like, that's worked. The jury is perhaps more out now on the euro than it ever has been. But I won't cover the ground the others have. If I sort of stick on my asset allocation hat, and in terms of markets, I think the dollar weakness story is now off the table for the next 6 months. And traders who, by the way, change their opinion every 6 minutes will at some stage revisit that. And I think kind of you'll have marginal effects. US exporters' earnings in a few months' time will be marginally less strong. One interesting implication of the dollar is that you have lots of countries around the world who have dollar pegs are quasi-dollar pegs, a lot of them in Asia and in emerging markets. And as a result of that, they're importing lots of kind of cheap money. And they're doing kind of the same thing as we did in the last 10 years, you know, import very, very low interest rates from Frankfurt. And in those economies, if you look at house prices in Hong Kong, for example, you know, absolutely, you know, breaking through you know, record levels. So you potentially have asset price bubbles arising from countries' links to the dollar. If I turn maybe finally to the pound, I'm very, very cynical as to, you know, when you see sort of newspaper headlines forecast currency moves, because you know then it's time to kind of turn the trade. And you know, a lot of people now talking about the prospect of a hung parliament being bad for sterling. I think that trade, if you like, has now been so well signalled that it's been done, and it's actually beginning to reverse. And if you look at the positioning of investors, the last 3 months, hedge funds, speculative investors have been aggressively short the pound against the euro, and have been taking that off now. So in the short term, I could see the pound strengthening against the euro, and actually typically in a recovery type scenario, the pound tends to be stronger at this stage.
Could we move on perhaps just to open the discussion a little more to what affects people again in their day-to-day lives? The issue of labour costs, a hot topic on this island, particularly the impact that it's had in terms of cross-border trade. We need to move and cooperate as much as possible on this island. What do you think the key issues in policy terms are that need to be addressed to facilitate that? Maybe Michael, you might kick off on that one, and perhaps Paul Sweeney might like to come in on that.
I think one reason, if you go back to the last question, the dollar, one reason the US works extremely well as a sort of currency zone across the whole range of states is you have fiscal transfers between the centre and the states, but also the mobility of labour is very, very fluid. So potentially on this island you want to get towards a more mobile, potentially labour force, and that in my mind has got more to do with cultural, social, political issues as it has to do with economic ones. And maybe just to, as a final point, to go back to the first question on the 12.5% tax rate, that strikes me as just being bad or lazy thinking. Because it seems to me that whoever suggests this, all they're doing is taking a sort of easily understood or easily digestible, sort of part of the Irish economic model. And some of the Eastern European countries have tried to do this in the past without taking the whole of the model, without taking things like education, having an institution like the IDA, etc., etc. So in terms of joining the two regional economies together, there has to be a wide range of things, not simply changes in taxes.
Okay. Linda?
I'd probably pluck a lesson from Germany here. I mean, we talk a lot about gaining competitiveness through a currency devaluation, and that's certainly off the table now. But if you look at what happened in the 1990s, when after the exchange rate mechanism collapsed and countries fell out of the ERM, they did gain a temporary boost in productivity through a cheaper currencies in Italy and Spain and the UK. But it's not sustainable if it's not underpinned by underlying cost-effective unit costs of labor. And that's what Germany achieved over the last decade, not by relying on the currency, but rather by wage restraint, so that even though Germany is a very expensive country, their effective cost per unit of labor declined by about 1% every year over the last decade. And that's how they were able to achieve real productivity strength that drove their exports and ultimately drove their growth. Of course, the downside to that is what we see in terms of low levels of consumption in Germany. There isn't very strong income growth and consumption. But in terms of, if you want to think about competitiveness and productivity, then I think they have achieved that. But as I say, the downside of it is they are 40% determined by exports in their economy, and they have to rebalance that. But rather than go down the road of just relying on the currency or not or anything, or not worrying about the underlying productivity strength. They need to be competitive. That certainly is something they were worried about. And I think when you look at competitiveness and technology and innovation measures, German workers are the most productive and innovative in the world, typically right up there with the Americans. And I think that strategy has a lot to say for it and may well hold lessons for this island.
What's your perspective on this, Barry, looking at it from the US?
Well, so, you know, I certainly agree that labor costs are important. And it is my impression from talking to my Irish friends, I have a limited circle of economists with whom I talk, that Ireland is different from the other European economies that are in trouble, in that there is a recognition here that labor costs need to be adjusted. And there is more willingness to do something about that than in Greece or Portugal or the other places where adjustment will have to come as well. So that makes me, on the basis of relatively limited knowledge, I must remind you, relatively optimistic about Ireland. The other thing I think I would add is that it's not all labor costs. Will was right to emphasize the importance of the knowledge economy and all that. When I think about Ireland in comparison with successful knowledge economies, be they California or other cases he mentioned like Israel, I see two things. I see business university collaboration that really works, where university faculty with ideas start businesses and get funded over a weekend, and where people in business go into the university and start programs. So I would ask whether it works equally well here. And the other thing I see when I look to California or Israel or other successful knowledge economies is that the entrepreneurship and the science expertise comes disproportionately from immigrants. You know, they all come to California from India and dozens of other countries, and that's where the high-tech sector in Israel came from as well. So I would ask again, in the absence of more knowledge, does Ireland capitalize on that opportunity?
My name's Tony Gallagher, Department of Finance. I'd hoped to speak earlier while Will Hutton was here. And it's in relation to his very alarming figure of the 700% debt. I think it's important to point out that that's massively distorted by the operations of non-Irish banks at the IFSC. Unfortunately, I don't have the correct figure, but it's way below half of that, and it is, we can manage.
Thank you very much. Thank you.
Hugh Logue. It's a question following on from what Will was saying. And, okay, we've had a clarification, but his calamitous scenario, Madam Chairman, was based on taking the bank debt onto national debt. Was there an alternative to that? I want to ask Michael and Linda and Barry. And is there now a way of offloading it? I noticed that Michael says that there's a 7-year consolidation process thereafter, and you are nodding. Is there a way, well, the question really is, could it have been avoided? And now that we're in the situation, is there a way of offloading it without us going through that 7-year period that took Finland, Sweden, and the others?
Well, with hindsight, there are lots of things that could have been done to avoid it. And if you look at countries, go back 3 or 4 years, look at the list of countries with extremely high banking sectors relative to GDP, and they were Iceland, Ireland, Switzerland. And of those 3, one was very well equipped in terms of having the people and the intent to actually go in and examine the banks and put together rescue packages. One of the things I find difficult in Ireland is NAMA as a topic. It's very, I find, even observing others, very hard to have a dispassionate debate about NAMA. It's become very emotional in terms of a debate. I think, to go back to an earlier question, the Irish banks are actually quite different to the UK banks in that they don't have big investment banking operations. They didn't really have toxic assets. What's happened to the Irish banks is much more like many of the banking crisis in the late 19th century, and you had lots of those in the UK, for example. Just too many loans, too many bad loans, and not a sustainable business model to recycle those loans. So we're quite different from the JP Morgans and the Royal Bank of Scotland. And I won't go back in terms of saying, well, what could we have done? The other thing I would do now is that it's not yet clear that NAMA is going to succeed. So I think we need to have a plan B. And in terms of a plan B, I would look at a number of things. For example, we could have used the post office network, for example, as a new national retail bank, or perhaps we could begin to convince some of our oligarchs to set up a new good bank, for example. And I think in Ireland we need to introduce more competition into the banking sector, allow more banks, be it Santander, Bank of China, by the way, who are increasingly operating in the UK. So I think it's more a case of coming up with a serious plan B in case NAMA doesn't work.
Barry, do you want to come in and last this stage?
I'm not enough of an expert on NAMA to really comment on the Irish case. I would make a couple of observations. One is, of course, the big mistakes were the ones made before the crisis. All the mistakes you and we have made since pale in comparison. Number two, your run-of-the-mill banking crisis costs, what, 15% of GDP to clean up? And this was more than a run-of-the-mill crisis. So the fact that it has been costly and, leaves behind a legacy of a large amount of additional public debt is not at all surprising.
Linda, I know that Hugh will want your response on this one.
Yeah, I'm not sure you should bank with Bank of China, by the way. The state-owned banks have a lot of non-performing loans in China, and who knows what their balance sheets look like, but I agree with the general point. I think probably looking ahead, taking stakes in the banks, if we were going to socialize the liabilities anyways, then having a stake in the bank and waiting for the underlying bank assets and bank shares to appreciate and then offload them, which is generally what's been going on now, faster in the United States, is certainly preferable than just socializing the losses without actually taking a stake in the upside. So I think it will take some time, but given that there is a state ownership stake in a lot of these banks, the money can be recouped in the future, especially if most of the underlying assets are linked to housing, and housing over the long term may well generate some return. So I think the alternative could have been we just bail out the banks, let them get back on their feet by making lots of trading profits, and we just socialize the losses and have no upside. But I think all the governments have actually taken a stake. So even though it's depressing balance sheets now in the public sector, at least there's a hope that we could see some return of it, say, within a decade, which is what happened in the Swedish case. But just unfortunately, that's a very long time horizon for most European politicians. So they all want to offload their stakes now. We'll see.
Could we move on? Sorry, yes, please. Yes. So.
Isn't there a problem that the pressure from the market, and markets in particular, are going to force states like the UK to sell off their shares in banks because of the pressure to consolidate the fiscal finances? And this is a real issue, because I fear in the UK, with a Tory government, they will start to sell off. We're now making a profit on our investment, when the real solution of this is for them to hang in there and get the return in the future. And this short-term panic for fiscal consolidation is promoting this, which means that we will share the losses but not the profits. What do you think about that?
Yeah, no, I'd agree with that. I think because of, as I say, the time horizon is very long to recoup some of this. And if you look at the British budget deficit, everybody breathed a sigh of relief when it came in 0.2% below the projection. It's still a staggering 11.6%. So yes, there is now a lot of talk in Britain about selling off RBS and Lloyd shares, because for the most part, the stock market has risen by so much that we're nearly now at the point of recouping what we've put in. And I think if the Tories come to power, they're going to make, they're going to try and make a political point of it by creating a people's bank bonus share, where they're going to sell these shares at preferential, give these shares at preferential prices to the populace. So all of that may well happen over the next few years. But I suppose, given the state of the public finances in Britain, getting that deficit down, if it brings down the borrowing costs associated with the structural deficit, may well be the only option these politicians have.
It's not as bad as you portray, because while we have the same fiscal deficit as relative to Greece, the maturity of our debt is much longer. So this year we come to the market to renew our debt for much less than Germany and France. And our debt ratios, 75 years of the last century, we had a debt ratio as high as 80%. Our interest rate on the debt is only about, payments are only 3.1% of it, significantly lower than Greece, where you mentioned 7%, and Malta is probably higher than that. So I think there's an element of scaremongering here in terms of the British debt position, and I think Will Hutton also suggested that as well.
I think very briefly, I think that is not unsustainable. However, I think one of the reasons why Britain has grown faster than many countries in the continent is because it's always been able to keep its stock of public debt very low. So yes, it's true, the average duration of British debt is 14 years. The average interest rate is 4.5%. When you take off inflation, that's below the trend growth rate of 2.75%. So by the sustainable debt rule, there's no indication of explosion. But for a country to stay, but one of the advantages of Britain has always been it had over long periods in the post-war period maintained a debt to GDP ratio of only around 40%, which is below the OECD. So I think those who want fiscal consolidation to come faster is because they don't want to wait until 2031, which on current budget projections under any of the parties is when the debt will come down again to 40%. And the other thing that makes this debt a little bit more worrisome is that after financial crisis, this is not a normal crisis. After financial crisis, if your potential growth rate has been reduced, say to 2% or 1.75%, then the difference between the real borrowing cost and the growth rate means the debt will explode, which is why the IMF says we will have a debt to GDP ratio of 100% in 2014 based on depressing the potential growth rate. But I think I'm always one of those people who are very cautious about public finances, and if they can bring down the deficit, halve it in 5 years, I would certainly prefer to see them do that than to risk, as I say, this divergence between borrowing costs. And wait till the Bank of England sells off its £200 billion worth of gilts. That's a fifth of the gilt market.
Thanks very much, Linda. We have another question on this table at the back, please.
Michael, you suggested a couple of actions, and Linda, last night we were talking about one other action. You suggested, Michael, a significant rearrangement of institutions, but didn't want to talk about who. I'd be very interested to draw you a little bit more on that. On the island of Ireland, we had set out through two different investment programs, north and south, a investment in our infrastructure of about €100 billion over 10 years. There's probably a key decision for us on the island of Ireland as to where we take that program. The Republic has already shown that they're going to cut back that program. On the radio this morning, there was a very strong indication that that's precisely what the UK government will do and Northern Ireland will consider. Could you give some advice on whether you think that action is a good action, particularly in light of the comments that Will Hutton made and some of your comments today? Thank you.
Okay. Well, I can give you a list. It's probably a long list of the institutions that I personally think need to be re-engineered. The way I would put it is we need to think in terms of a sort of a second republic, and this is, before I kind of alarm anyone here, more in terms of traditional republicanism, going back centuries, building good, strong institutions. Some of our main political institutions, I think, need to be reformed totally. I think we need new financial economic institutions. We need some kind of I think Council of Strategic Advisors, not to advise not just on the economy, but on a whole range of things, be it food policy internationally, defence, that sort of thing. In terms of your question on an investment, one point I do want to draw out, and I think this is a puzzle that needs to be addressed by be it people in the Central Bank, Department of Finance, is that we've had a puzzle in Ireland in the last maybe 10, 15, 20 more years, unlike places like California and Massachusetts, where very, very little private savings in Ireland has gone into investment in Irish business. And it's a puzzle because it stands out by comparison to other countries. It stands out even more by comparison to the amount of capital Irish households gave to the housing market and associated kind of hot assets. So that's one of the kind of institutional things I would like to see solved. And I think when we do that, it will be better for the Irish economy, because it's very fashionable to talk about things like the green economy, all that kind of stuff. It doesn't create that many jobs. It's very capital intensive. It's also fashionable to talk about, and easy to talk about, getting more multinationals into Ireland. But the thing we haven't really solved as an economy is, I think, to get Irish, Irish people actually making and selling things internationally. And a lot of those skills have been underdeveloped during the boom. I think if we're going to have a sustainable period of economic growth in Ireland, that's the area that needs to be focused on, not fashionable things like the green economy or multinationals.
Sean Gallagher, entrepreneur and board member of Intertrade. I guess given the in-depth analysis and understanding of the fluctuations in the various economies, all of these things are great, but they must be translated into a set of strategies and actions in order to run a country and an economy. If you, as panelists, were charged with being the advisors to the political and economic leaders here on the island of Ireland, North and South, and you had only 3 priorities, urgent priorities, with which to lead in order to secure the economies here, what would those 3 priorities be?
This is the exam question, ladies and gentlemen. So we'll start with you, Michael. You're on first.
There's this inherent contradiction in being an advisor to the politician, because somewhere in between the idea may not get through or be followed up on. But anyway, 3 ideas would be build new institutions, like the one I mentioned, to offset low interest rates. Find a means of providing the skills, the investment capital to develop some, the beginnings of a domestic services and manufacturing sector. And perhaps one of the other things would be have a plan B if NAMA doesn't work, and if house prices don't rebound as sort of the optimists would suggest.
3 bullet points from you, Linda.
This is what we do
no
to
pressure.
Students. No pressure. I'd probably say get the fiscal house in order, which certainly, and to do it in such a way that reduces costs, labor costs, to gain productivity, and but be strategic about it. So rather than cutting investment funds, things that could actually reorientate the economy towards what the future growth drivers will be, higher value-added green technologies, higher value-added services. Those need to be invested in today. So I think it has to be using the opportunity to reorientate the priorities, keeping costs down, but build the infrastructure institutions to push ahead. Second, policymaking has to be completely revamped. I don't think any of the monetary fiscal policies are appropriately set, and I think this crisis really highlighted that. And third, have a recognition the world has changed. The fast-growing markets in the world now are in Asia, and they may well be more volatile, but if you want to grow quickly, I think looking to the West, Western Europe, and the United States is going to give you the kinds of possibilities of growth that Asia offers. So I think it has to be a reorientation towards the needs of those markets. And those are my 3 bullet points, although I realize my first point had 2 subheadings.
Okay, that's allowed. Barry.
So having been in Europe and Ireland now for almost 24 hours, I feel fully qualified to advise Irish policymakers. So my 3 points would be, number one, you have a serious problem of short-term stabilization and consolidation, and you need to get serious about that. Cutting the budget, cutting costs. In my 24 hours, I haven't heard anybody revisit the 1980s and the social pacts that Ireland used to achieve that then. You had the advantage of a flexible exchange rate, which you don't have now, but you have all, you know, everybody complains about not having the right institutions, but the wrong ones worked in the 1980s and you still have them. So you ought to use them. Number two, I think Will was right about thinking about a medium-term strategy and the fact that Ireland is well positioned to move into what we call knowledge economy activities. And you know, I'm an academic, so I think what you ought to be doing more systematic, serious business, university collaboration than you do. And number three, then get government out of the way.
Well, you've seen diverse views there. This has been a fantastic morning. Our thanks to your three speakers who've done a wonderful job for you.
Well, in the next few minutes, I'm going to try and summarise all of what you've heard and indeed some of the audience contribution. First of all, can I once again thank our visiting panel for coming here and for travelling and joining with us, and also our chair. That was a first-class session, and I think we all really want to show our appreciation. A week or so ago, we were very worried about the impact of the Icelandic volcano, and it was interesting that, Barry, your first slide, you started off with that volcano. And I think it serves as a reminder that there's always the risk of some chance happening. And indeed, after trying to plan ahead and think of how we can get out of recovery, I think one of the things we have to keep in mind is that we're not quite sure just what's around the corner, or in the words of Linda, in terms of toxic assets or whatever, what's just lurking in a corner in a vault somewhere. So I think one of the key things for all of us is to remain alert and agile. I think we started off talking about the difference in trajectories of economic recovery, the difference between the US and Europe. America, I think Barry was targeting around just 3%, and Europe at 1%. And Linda was talking about China at 8%. And all of the speakers, I think, developed views on what was driving the growth in each of those regions, with perhaps the US being driven by domestic consumption and perhaps a recovery in housing, albeit, Barry, you provided evidence that that recovery just wasn't there. Linda was talking about China trying to stimulate domestic consumption, but still very much reliant on exports. And Will and Michael both covered the issues about the knowledge economy. There was a new one in me where, Linda, you introduced new terminology, which I know Roy Adair and others will be using ad nauseum going forward, which was about the technology horizon. And for those countries that were above it, we needed to embrace the knowledge economy and innovation, that we had to really use that. I think what came out of perhaps both Will and Michael's bit was Ireland at the crossroads, and that's a terminology which has been used in politics in the north a lot, but this time we're talking about the economic crossroads, and we hope that going forward we have, after today, more informed choice about the right route to take. Linda talked about, and not just Linda, I think again Will and Barry, about China's rapid growth, but also the risk of growing pains. Linda held out the hope of China having or playing a key role as an economic engine in the recovery, but there was also, with Will, the threat that perhaps there was a lurking risk of a banking crisis in China, and certainly the risk of inflation. I think coming out of today was very much the challenge that we in Ireland, North and South, need to look at developing our knowledge-based economy, and that, according to Will, was what was going to lead us out of recession. But the events could overtake us, and certainly there was a spectre of a domino effect in terms of the euro and monetary union in Europe, with Greece destabilising the euro, coming out and having knock-on effects for both Portugal and Ireland. So I think May the 13th has now been inserted in my diary. Prior to today, I wasn't worried about May the 13th. Thank God it's a Thursday and not a Friday. So let's hope the Bundestag do the right thing. I think also what we got today was more about the jobless recovery. The risk that we're going to see some economic growth, but we're not going to see the job creation. I think everyone was saying that the public sector as an engine of employment. We had new terminology, new for me. We had innovation ecosystems and flexicurity capitalism. I think Will Hutton is trying to angle for a comeback tour because I think he was offering to help us in Intertrade broker North-South cooperation and innovation. And joking aside, that is one of our key objectives in Intertrade, because we, with both governments, have identified innovation and cooperation on an all-Ireland basis to create the critical mass and to use the centres of excellence, the universities that we have north and south, to help drive. I didn't hear too much about universities coming out today, and I thought there would be perhaps a little bit more about what are the engines for the knowledge-based economy drive. Will give us a model which I just couldn't write fast enough to take down. I'm not sure if we've got the slides, but if we have, we will circulate them to you, and you can go home, read his model, and see if you can come up with a better one. I think coming out of today, we will post everything on the website, and there'll be opportunities for people to post comments. But it's pretty clear it's not going to be a reversion, business as usual, and I think Barry started off with, again, a new terminology. I mean, I'm going back through my notes here in terms of the economic theory, the Zarnowicz recovery theory, or Zarnowitz's law. And I think what you're saying, Barry, it's not going to happen. And I think most people are saying we might have gone down pretty fast, but we're going to come back slowly. Hopefully, we're going to see some benefit from the BRIC countries in terms of creating some demand for Irish goods and products, but there's certainly going to be a shift in gravity towards the developing economies. Consensus energy innovation is the key to our recovery, but also a significant challenge on how we can mobilise ourselves to exploit the knowledge in this island and to market it in a global economy. Cooperation between the north and the south of Ireland certainly came out in a number of speeches or presentations this morning, and particularly now given the common difficulties in terms of public finances and the common challenge in terms of how to export off this island. So we're certainly going to be following up in Intertrade Ireland some of the themes that came out today, and together with our sister agencies in terms of InvestNI and Enterprise Ireland. Our job, we're in the business of trying to rebuild the economy and support the private sector to grow and to recover its position. So I think for me, there was certainly a number of themes and ideas coming out of today, and I know Intertrade Ireland Board, which meets this afternoon, is going to have probably quite a stimulating and exciting meeting in terms of how we can follow this up. I hope all of you take away something for today, from today, and that in some way we've stimulated your thinking and perhaps may change what you're going to do tomorrow. Once again, thank you, Maeve. Thanks to our three speakers and to Will, who's gone. And thank you, ladies and gentlemen, for coming today and making the event so worthwhile and so productive. Safe journey home, wherever that may be.